So when I've got an asset valuation that you are doing. The other thing that I heard you say is business valuation. Okay, explain that.
So the business valuation now looks at how has this company been performing. Fine, they have all these assets, but to what extent are these assets generating revenue for the business? And how efficient is this business? So investors, fine, you have nice assets, but I can't sell a pipeline, right? Where will I sell it? Yeah. I want to know how much revenue is this pipeline generating. So the business valuation has a very important component because it looks at revenues, it looks at the cost of those goods sold to be able to generate that revenue. It looks at the expenses, administration expenses, staff costs, all these different costs. And then we have the profit that comes after all these expenses are taken out. What is that profit? And then we have tax and all these different things. So you look at that 5 years prior, and then you also want to project in the future to see, given the strategy that this company is looking to get into, what is the likelihood that they're going to make the kind of revenues they're saying in their budgets that they're going to generate in the future? And so you do like a sense check of that in collaboration with the reporting accountant, who's also checking and making sure that the numbers are correct and so on and so forth. And then you do your projections. And so you can decide, I'm going to see from a different methodologies, whether that's free cash flow to the firm, a dividend discount model, a dividend yield model, a relative valuation model. There's different kinds of models that are used for valuation. You come up with a value based on certain assumptions of the business. So you also have, now you can decide to do what we call a sum of parts and say this is the assets and this is the
business value.
That's not correct. The assets are a different valuation methodology, which then is like a net asset value. What I meant to say is they have two companies. So you would then take the valuation of one company and do a sum of parts, basically saying they add this valuation to this valuation, it gives us a total valuation of this, because you have two companies, Kenya Pipeline Company and its wholly owned subsidiary, KPRL.
Which you explained.
Yes, which I explained earlier.
Yeah. Okay, so after doing all this, what did you guys learn?